Hello to everyone. I am Nicolas Bornozis, President of Capital Inc. We are delighted to welcome Mr. Tom Lister, Chief Executive Officer of Global Ship Lease, to today's Trending News webcast series. Global Ship Lease is a leading independent owner of container ships with a diversified fleet of mid-sized and smaller container ships. As of June 30, 2026, the company owned a fleet of 71 ships, of which 41 are wide-beam post-Panamax. The company is listed on the New York Stock Exchange under the ticker symbol GSL. Now, before we begin, please let me go through the traditional disclaimer that this discussion is for informational and educational purposes only. It should not be considered advice of any kind or an offer to buy or sell securities, and Capital Inc., of course, bears no responsibility for the content. Now, Tom, again, thank you for being with us today. We appreciate very much the fact that you're taking time to discuss the company's second quarter 2026 results, your company strategy and sector outlook. It's a great opportunity to follow up on key developments and get your insight on market trends. Now, what we're going to do is we are going to start with a brief presentation by Tom, and then we will have a Q&A and we'll have a discussion. So, if you don't mind, I will turn the floor over to you, Tom.
Perfect. Well, thank you for inviting me on, Nicholas. It's a pleasure, as always, to be here. You kindly provided a quick snapshot of GSL in your intro, but I thought it might be useful to provide a few additional details for the benefit of listeners who are unfamiliar with the company. So if we turn, please, to slide 2. Thank you. This slide provides a useful overview, which is extracted from and cross-references to our recent 2Q26 earnings call. And all information, I'm obliged by our lawyers to say, is covered by the disclaimer and safe harbor language included at the tail end of this brief slide deck. So, as it says on the tin, Global Ship Lease is an owner and lessor of container ships. And as you mentioned, we're listed on the New York Stock Exchange under ticker GSL, added to which we're rated by the big credit rating agencies, Ba2 positive by Moody's, BB plus stable by S&P and KBRA, and we also have some investment grade paper in our capital stack. We own a fleet of mid-size and smaller container ships, which is shorthand for container ships of between roughly 2,000 and 10,000 TEU, which we time charter, wet lease, in other words, to leading container shipping lines like MSC, Maersk, and CMA CGM. In short, we provide the ships and the crew while our customers utilize and direct those ships as they move containerized cargoes around the world for the likes of Walmart, IKEA, Ford, and other cargo owners. And importantly, our customers pay for the fuel. Mid-size and smaller container ships such as ours are enormously operationally and commercially flexible, which makes them very valuable to our liner customers at a time of both geopolitical and macro unpredictability and supply chain fragmentation. Why? Because these flexible assets provide valuable optionality at a time when the sands are shifting beneath the feet of the container shipping industry and where the ability to efficiently access a large number of global ports instead of only a small handful of the very largest hubs is becoming ever more crucial. Obvious examples of this disruption, which no doubt we will discuss further in the Q&A later, are those caused by conflict, such as that besetting the Middle East, and by trade tensions, particularly between China and the US, which are causing supply chains to become more complex and less efficient. Almost invariably, disruptions such as these stoke demand for more shipping capacity, which in turn is supportive of earnings for providers of that capacity like Global Ship Lease. And you can see evidence of this in the financial metrics we provide on the right-hand side of this slide. In the first half of 2026, we generated net income of over 180 million from revenues of a little under 400 million, meaning that we generated net income at the rate of just about $1 million per day. Over the same period, we have an EBITDA margin of a little over 65% and generated earnings of a little over $5 per common share. We have a market cap of around 1.5 billion, good share trading liquidity, and we pay an annualized dividend of $2.50 per common share, which translates to a dividend yield, at least on the basis of yesterday's close, of around 6%. With that all said, I'll come back to the trending news we're focused on today, which is container ship new buildings in general and our own 15-ship new building program in particular. So if we could move to slide 3, please. Great, thank you. So you can all see how cyclical and volatile our industry is, which is both its challenge in that there are significant risks to manage, but also the reason it's attractive, because as long as you are patient, disciplined, and nimble, which is really our mantra, there's very good money to be captured from that cyclicality. As hopefully you can see from the chart, we have a history of being prudent in managing risk throughout the shipping cycle while capitalizing on upside cyclicality and upside volatility, particularly in the time charter earnings, to build value for shareholders. You can see how the second-hand price index, the dark blue line in the chart, and particularly the time charter rate index, which is the green line, have both trended and spiked upwards, while the new build price index, the pale blue line, has remained comparatively flat in recent years. In fact, with yard order books essentially full for the next few years, the main factor currently expected to drive new buildings is price inflation. So, combining all these considerations, this is a good entry point for new builds, as long as they are in the right size categories, appropriately specified, and de-risked with charters. And with the combination of our fortress balance sheet and strong industry relationships, we had the ability to move quickly and decisively in developing these compelling opportunities. The result is 15 new builds contracted on attractive terms with multi-year charters attached, which lower our average fleet age and increase our cash generation runway as our cash cows, our existing cash cows, begin to age out. So, in other words, exactly the recipe for low downside risk and high upside potential that we like. If we turn now to slide 4, this slide builds on the quote-unquote right size categories point. The bar chart on this slide shows the age profile of the global container ship fleet by size segment. Essentially, the grayer the bar, the older the segment. Long story short, the mid-size and smaller container ship classes have been underbuilt for many years, with the lion's share of investment capital piling into the ultra-large ships. That has left the crucially important sub-10,000 TEU portion of the global fleet with an advanced age profile. To illustrate this point, the median age of the oldest quartile by TEU capacity within each fleet segment below 10,000 TEU ranges from 21 to 28 years today, which translates to around 24 to 31 years by the time our new builds actually deliver, because they're delivering between the tail end of 2028 and the early days of 2030. So I would ask you to keep this in mind when looking at slide 5. If we could turn to that slide now, please. Thank you. And here you can see that the overall global container ship order book, which will deliver over the course of the next 4 years or so, still remains heavily weighted toward the really big ships over 10,000 TEU. So, to underline the main points, you have an aging global fleet for mid-size and smaller container ships, combined with a more limited order book at a time when the value proposition of such flexible assets is proving to be increasingly important and in growing demand from the liner operators. And then if you overlay these considerations with the facts that, number one, shipyards are full for the next 3 to 4 years, 2, new building prices are inflationary, and 3, the industry and its regulators are now looking less likely to coalesce around a long-term decarbonization trajectory and rule set anytime soon, meaning that the option value of a wait-and-see approach on fuels and propulsion has materially diminished, and you have a clear rationale for pouncing on the right new building opportunities, at least in our view. That brings us to slide 6, where you will see greater detail on our ongoing strategic fleet renewal, which consists of both investment in the next generation of cash cows for our fleet and the opportunistic monetization of older non-core assets. So we see our acquisition of 15 mid-size, ultra-high reefer, wide beam, latest generation container ships with long-term charters attached as the exact combination of prudent downside protection and attractive upside potential that we look for in a transaction. So breaking down some of the ship-related jargon, for mid-size, read operationally flexible. For ultra-high reefer, read ships with the ability to carry lots of controlled atmosphere cargoes, which are money spinners for our customers, making the ships commercially attractive in the market. For wide beam, read low slot cost, meaning cost competitive. And for latest generation, read fuel efficient. So summing it up, highly specified ships in a structurally underbuilt but crucially important segment of the container ship fleet. And we see these ships as best-in-class, flexible, future-proofed, and strong earners going forward. And it's worth underlining the fact that more than $1 billion of the $1.3 billion contract price for these new buildings is covered by contracted adjusted EBITDA expected to be generated by the firm charters in place ex-yard over a TEU-weighted average term of 7.1 years, meaning that these new builds are materially de-risked right out of the gate, and essentially we are covering over 3/4 of their aggregate contract cost within roughly the first quarter of their collective economic life, and all with charter cover from top-tier charterers. It's also worth highlighting that several of these new builds include options for the operator to extend the charters at rates more than 25% above those for the initial firm periods, suggesting that our customers, the end users, share our conviction that these ships will continue to be in high demand, valuable, and with significant upside earnings potential well beyond their initial charters. So these new build transactions were possible due to our ability to move fast, thanks to our discipline in building a fortress balance sheet. And we expect the forward visibility on contracted revenues to support attractive funding alternatives for these ships, which will likely involve a combination of cash from our balance sheet and debt to enhance returns on equity. And it's helpful to keep in mind that the contract payments for these new builds are milestone-based and backloaded, with more than half the contract price not payable until the respective ship is actually delivered. By the way, we also consider the opportunistic monetization of older assets to be an integral part of fleet renewal. And at the bottom of the slide, you can see that we have sold forward 4 older non-core ships during the first half of the year for a total of $65.5 million, with an aggregate gain on book expected to be in the region of $33 million. Added to which, we will continue to benefit from these ships' earnings until they deliver to buyers in scheduled slots ranging between the end of this year and the end of next year. So, in summary, GSL has benefited greatly from the virtuous cycle of strong contracted cash flows, ever-improving balance sheet, great credit ratings, and a commitment to optionality that has enabled us to make disciplined, opportunistic investments from a position of strength, and thereby continuing that virtuous cycle. With these new build orders, we believe that we've taken a very important, highly value additive step in sustaining those benefits well into the future. So, Nicolas, I'll end there and pass the call back to you for Q&A.
Tom, thank you very much for this introductory presentation, actually quite thorough and quite to the point. Now, allow me, we have a lot of topics to cover and a lot of questions to ask you. So let me start with the first one. Let's talk about the market conditions and touch upon your results. Now, the first question to ask, now, is the Strait of Hormuz and Red Sea closed or are they open? And how is this affecting your operations and customer conversations?
Yeah.
I mean, with your every day, it's something different. You navigate that daily, so what's going on?
Yes, and whatever I say today is unlikely to be accurate tomorrow or the day after. So, I mean, I think embedded in your question is the observation that it's a tremendously unpredictable environment. So there has been optimism followed by pessimism, followed by optimism. There are a handful of liner operators who are tentatively dipping their toes in reintroducing services via the Red Sea and Suez. So I guess we'll have to wait and see what happens on that front. Although I would observe that by and large, ships that in quote unquote normal times transit the Red Sea and Suez tend to be the bigger ships transiting from, Asia to the Middle East and Europe. And so it's likely to be less impactful for mid-size and smaller ships, whatever happens really within that particular trade corridor for us. As to the Strait of Hormuz, I really wouldn't even hazard a guess. That's a situation which is highly dynamic. And I think the thing that, both we and the industry as a whole have to keep in mind is seafarer safety when it comes to assessing the pros and cons of transiting there. We don't have any vessels that are deployed within that trade as things currently stand.
Thank you. Now, given what's going on, how are charters thinking about their demand outlook? Given, as we discussed, the reshaping of trade from choke point disruptions. Now, is this a temporary flight to flexibility, or is it a more permanent shift in how liners want to structure their fleets? Because at the end of the day, liners need to continue the liner service no matter what.
Okay. Good question. I'll try and break it down. So your first question was, I think, about demand, um, real underlying demand, and I think it's quite striking that the latest data that I at least have seen shows that containerized volumes grew in the first half of this year by roughly 5% versus the first half of 2025. So it seems that real demand, as opposed to demand synthesized as a result of disruption to the supply chain, continues to grow. As to whether or not the demand for mid-size and smaller container ships, flexible container ships, is the new normal or a flash in the pan, I don't know. But I think given, we think about this all the time, and given that I can't give you a clear answer on that, I think the implication is that having optionality at your disposal, both as an owner and as a liner operator, is valuable, and mid-size and smaller tonnage provides optionality because it can be deployed anywhere and everywhere. So I would think that as long as we're living in an unpredictable world, there will be an appetite from liner operators for such tonnage.
Thank you. Tom, I noticed that in our discussions over time, you always focus on optionality, which is the right thing to do because the optionality provides you with the flexibility to respond to changing market conditions. So let me move on to the next question. Idle capacity is now just 0.7%, less than 1%.
Yep.
And the scrapping is basically frozen. So
Yep.
what does that combination tell you about where we are in the shipping cycle?
Yeah, I don't know how much it can tell you about where we are in the shipping cycle per se, but I mean, to state a very obvious point, it tells you that the fleet is at pretty much full utilization at the moment. There is no slack in the system at all. So wherever the market goes from here, it will be progressing from the point of full utilization, which I think means that obviously at the moment we're in a very strong earnings environment, which goes to the point I made in my introductory remarks. Every provider of capacity has been making extraordinary returns, generating a lot of cash for shareholders during this period of time, which means everyone has a strong balance sheet at the moment. So wherever the market goes from here, I think we consider ourselves to be nicely positioned. So I don't have a neat answer, but in some ways, from a business perspective, I don't need to have a neat answer because if the market continues where it is, we'll continue to make money from our existing fleet. And if the market corrects to the downside, which means that asset values correct to the downside, well, that would be an opportunity for us to go shopping and capitalize on that opportunity. So, sorry, not the answer you're looking for, but I think it's the best I can give.
Well, you're pointing to a direction, and that's good enough. So, going now to your results, rounding up the figures, you had a very strong quarter. You reported 397 million in revenue and 265 million in adjusted EBITDA for the first half of 2026. So, given the market environment, can you discuss? I mean, you already did, but if you can repeat the highlights of the key factors that shape these results. And actually, I have a question. Can you explain how, on one hand, utilization improved to 97.4%, while EBITDA was modestly lower year over year?
Ah, okay. I'll tackle that part of the question first. So, I talked during the presentation about our monetization of non-core assets. And that's relevant not only for what we're doing this year, but what actually we did last year. So we sold 4 non-core assets and delivered them to buyers during the course of I think it was the first half of 2025. And obviously, if you sell ships, great, you monetize those assets, but you lose the EBITDA that's being generated from those ships. So I think the period on period comparison is a function of us having actually one fewer ship within our fleet, so one fewer generators of EBITDA within our fleet, while at the same time utilization was up because off hire for things like dry docking was down. So on the face of it, it's a paradox, but actually, if you look into the numbers, it makes sense, and we try to provide enough material in our public materials to allow both analysts and investors to model out our quarterly cash flows and EBITDA. And typically, we deliver results which are very, very close to consensus, as we did here. So it came down a little bit, but pretty much everyone was modeling it to come down for the reason I've just described.
Thank you. So now let me ask you, net debt to adjusted EBITDA is down to 0.4 times, actually less than 1 times, compared to 8.4 times back in 2018. So at what point does delevered start to look like underlevered from a shareholder returns perspective?
Right. Yeah, that's a very good question. I think the answer depends upon the industry in which you're operating. So, as I demonstrated in the presentation, we're operating in a highly cyclical and highly volatile industry, which presents risks that you've got to manage. And obviously, leverage is one of those risks, and also opportunities to jump upon. And the new buildings, for example, are some of those opportunities, but we've also capitalized on the cycle by buying ships at the right point in the cycle. So I think the combination of a strong balance sheet, meaning having cash on balance sheet, plus low leverage, it gives us the word I used was fortress balance sheet that allows us to both manage the risks and capitalize on the opportunities. And just because we have low financial leverage at the moment, it doesn't preclude us from putting leverage back on at the right time. Example, the new buildings themselves, we would expect to fund those with a combination of cash from the balance sheet and leverage. Why? Because it's appropriate to put leverage on younger assets with good forward visibility on cash flow. So we will always manage our leverage, Nicolas, dependent upon the risks, opportunities, and overall market context, and optimize for those circumstances.
So now talking about the fortress balance sheet, and I wanted to point out that 3 credit rating agencies have affirmed or upgraded GSL this year. So Moody's to positive outlook, S&P and KBRA holding double B plus. So how much of this is balance sheet discipline, ending up with a fortress balance sheet, as you mentioned, versus favorable market tailwinds, market conditions? Maybe a combination of both, I guess.
Yeah, I mean that would be probably my answer. It's a combination of things. Certainly, balance sheet discipline is vitally important to retaining, a robust credit rating. But also the financial health of one's counterparties is something that feeds into the mix. And, as a result, a strong market has helped not only us as a provider of capacity, but it's also helped the end users, the liner operators of that capacity. So that is also helpful. And I would say the rating agencies reacted very favorably to our new building program and fleet renewal, and the fact that we're layering on younger assets with very significant cash flows attached and good forward visibility on cash flows. So all of that, I think, is additive.
Thank you, Tom. Very interesting that you brought into the equation exactly the quality, the high quality of your counterparties, which plays a significant role in the overall evaluation. Now, let me turn on to this major development of the 15 new buildings. So walk us through, if you don't mind, the basic shape of this order. 15 new build ships, 1.33 billion, delivers, as we mentioned, stretching from 2028 into 2030. So why mid-size, ultra-high reefer, wide beam ships specifically, rather than another type of container ships or chasing bigger tonnage?
Yeah. I mean, I think that this comes back to the optionality point, Nicolas, that I mentioned and you highlighted earlier in the call. We think that mid-sized ships provide optionality because they can be deployed pretty much anywhere. They can either be used as sort of head haul traders or feeders at the option of the liner operator. They can be deployed in a multitude of geographies, and they're well suited to what we're seeing in terms of the fragmentation of the supply chain, particularly out of China at the moment. So it's a good fit to the evolving needs of today's market, and we believe also, given the optionality point, a very good fit to a future that no one has a crystal ball on. So optionality, that's one point. You also highlighted the high reefer content. Yeah, refrigerated containers, reefers, or controlled atmosphere containers are the containers from which the end users make the most money. It's very lucrative cargo. So a ship that has the capacity to carry lots of high reefer containers is commercially attractive to the liner operators. It also happens to be, if you break down containerized trade, I'm sure, you've done this analysis, and you look at the growth of quote unquote dry cargo, it's growing in volume terms more slowly than that of refrigerated cargo. So it's lucrative cargo, and it's a segment of, global trade which is growing faster, the refrigerated cargo. The next point or the next question, wide beam, was that what the?
Yeah, I mean, have you ever
Just low
thought of?
slot costs. It's efficient tonnage. The cost to the liner operators of each cargo slot is lower the more boxes you can fit in. So it's operationally flexible tonnage, but carries a lot of cargo basically. So it's low slot cost, and that's attractive too.
I remember from our discussions that the consistent theme is that the refrigerated cargo remains a very high growth area.
Yeah, that's right. That's right.
So you have already touched upon that, but I think it's worth having a question on the funding of this of your new building orders. You mentioned that you have a mix of balance sheet cash and debt, and interestingly enough, 50% of the payments backloaded to delivery, which I guess optimizes your capital outlay schedule. Can you elaborate on this?
Yes. Let's talk about the timing of payments first. So if you order a ship, there are various milestones in the sort of the ordering and building process, and the stage payments, the installments, tend to be linked to each of those milestones. So you'll have, a deposit you put down upon signing the contract, and then the next payments don't become due typically until steel cutting or so, which tends to, be anywhere between 12 and 16 months thereabouts before the vessel is delivered. Then you have keel laying, launch, and ultimately delivery. And as you observed, and as I mentioned in the prepared materials, the lion's share, over somewhere between 50 and 60% of the payment, is actually not due until delivery itself, which is great. So you're actually taking on the lion's share of the capital expenditure right as the vessels become cash generating assets, which is super helpful. And as for financing or funding, having a super strong balance sheet gave us the confidence to act on these opportunities when they came up. And we will be using cash from the balance sheet in combination, most likely with debt, which is something that we're working on already, as you would expect, to finance the overall delivery of these ships.
So continuing on the same topic, if I can ask you two questions. What gave you the confidence that this was the right point to commit to such a significant new build program? And then committing to that program, given the overall evolving regulatory landscape about decarbonization, green shipping, alternative fuels, and so on, how did you factor that into your decision in terms of what ships to order?
Sure. Maybe I'll back into that and start with the last piece first. We and a lot of other folk have been waiting for regulatory clarity from the International Maritime Organization, the IMO, the global regulator, when it comes to very long-dated visibility on decarbonization regulation. That was expected to crystallize in the fourth quarter or so of 2025, but for various political reasons didn't. And it's now far from clear when or even if that clarity will be forthcoming. Anyway, so long story short, the option value of a wait and see approach diminished when it became clear that the regulatory environment was not going to provide the clarity that everyone was hoping for. So that's one thing. It no longer made as much sense to wait and see as it had done up until that moment. And then as far as the other points are concerned, I mean, you saw from the chart the very attractive upward volatility that there is in time charter rates and secondhand asset values. But on the same chart, you saw that new building prices have remained comparatively flat and subject really only to price inflation. Again, that suggests that waiting for the right point in the cycle to order new buildings became less relevant. If it's purely inflation, it's never going to be purely inflation, but if it's principally inflation, which is driving the pricing of new buildings, then there's a cost to waiting. So again, act now. And then crucially, we have very strong relationships with the liner companies, the end users, which meant that we were able to construct a deal that combined taking a commitment on new building slots with having charter agreements in place, allowing us to de-risk the new buildings right out of the yard. If you're able to take 75% of the contract price risk off the table by way of charter agreements that are going to generate, that 75% in terms of adjusted EBITDA, tremendous. It also gives you a very strong platform, by the way, in which to put finance against those ships in due course.
I had a question just on that, but you covered it already, but it's worth reiterating. Here you have a new building program where 50% is backloaded to delivery when ships are going to start earning revenue. And with the charters in place, you recoup 75% of the project within the
first 25% of their lives. Yeah, exactly.
Yeah, so that's quite quite a package. But Now, staying on the same topic, very interesting question, I think. 5 of these new builds have extension options priced 25% above the initial charter rate after
Yep.
their initial multi-year charter. Now, when we look at that, what does this pricing signal to you about how charters view the medium-term outlook of your segment? If they're
Yeah.
willing to commit to another extension 25% higher, what does this mean?
Yeah. Well, I mean, we haven't disclosed who the various charterers are of these new buildings, but I mean, we have said they're top tier charterers. Now, top tier charterers think very carefully about the value of options, charter extension options. So the fact that we weren't willing to give options on the tonnage unless it were priced at this elevated level, you know, an uptick of 25% plus versus the initial period. And the charterer was willing to take and accept those options at that level. They were seeking the options. We weren't seeking to give them. Tells you something about the end user sharing our view that these are going to be valuable ships over the long term and very good earners over the long term. So I see that 25% uptick for the extension options as a very positive endorsement of the ships themselves.
And of the market outlook, I would think.
And of the market outlook.
So let me conclude with a question. Non-main lane trades are 75% more or less of global containerized volume.
Yeah.
And they are served, as you pointed out, primarily by sub 10,000 TEU ships. So why has the market taken so long? I mean, you took us through the dynamics of your segment in terms of new building, fleet age, and so on. So is the market catching up in terms of new buildings, in terms of ordering in your segment? And are you there? Are you one of the companies to be there first? I mean,
Look, I
we've seen
mean,
a number of companies actually placing orders in this
yeah,
segment. The market catching up with the.
yeah. I'll try and answer the sort of the big picture part of that question first, Nicolas. So for a very long time, liner shipping, which is now a comparatively mature industry, had fine-tuned its operations to a fairly stable operating environment. And that stable operating environment was huge pipelines of cargo coming out of China, primarily as the workshop of the road of the world, and flowing into, you know, the big consumer markets such as Europe and the US. And the really big ships towards which the order book is weighted are perfectly suited for that environment. Big pipelines, low unit costs, tremendous efficiencies. But they're less well suited for what has become the new environment, which is largely coinciding with Trump 2.0 of heightened tensions, trade tensions with China, and also, of course, you know, as we talked about earlier, there are conflicts that, you know, the world for a long time seemed to avoid. And under those circumstances of uncertainty, macro, geopolitical, and industrial uncertainty, and fragmentation of the supply chains, as both the US in particular and China in particular look to diversify away from one another, is a much better fit for mid-size and smaller tonnage. But it's all very well to make that observation. It actually takes time for the industry to pivot its ordering activity towards, you know, the quote unquote newly appropriate tonnage. And that's what we're seeing at the moment. Now, are we first movers? Probably not, but I like to think we're at least comparatively early movers in this retooling of the industry, yeah, for the new environment.
That's a good way to put it, a retooling of the industry. So we have reached the end of our discussions. It has been very insightful as always. Any closing remarks from your end?
Not really, Nicolas, other than to thank you and the Capital Link team for having me on. We've covered a lot of ground on the call as always, and thank you very much for the very interesting questions. Thank you.
Well, Tom, thank you very, very much for taking the time to join us today. And to our audience, please note that this webinar will be available for access upon demand across the Capital Link's website at capitallinkshipping.com and capitallinkwebinars.com, as well as on our YouTube channel, Spotify, Apple Podcast, and a number of other social media channels. So thank you to everybody for joining us. And Tom, thank you to you for being with us today.
Very much my pleasure. Thank you.